Okay, all right, so tonight we're going to talk about Chapter 14, Federal Governmental Accounting. So for federal governmental accounting, we'll talk about the basic conceptual framework, how federal governmental accounting is set up. We'll also talk about the financial statements that are required for federal accounting. There's obviously only one client when it comes to federal accounting. It's the U.S. government, right? So even though it's the U.S. government that files financial statements, there are subsidiary level financial statements, like, for example, the Department of Homeland Security would have a set of financial statements, Department of Interior. You'll see that for federal governmental accounting, the financial reporting is somewhat similar to state and local governments. As you'll see tonight, they do have different funds. We know that a fund is set up as a separate set of self-balancing books. So when you have a fund, you can aggregate financial information, run financial statements at a lower level. So we'll see how the federal government is kind of similar to state and local governments. And then we'll talk about how federal governmental accounting works in terms of journal entries. So there will be a journal entry question or problem on the exam. So we'll talk about how that works. Okay. All right. So if you look at the notes from Chapter 14 tonight, you can see that there's a lot of different names of entities, a lot of different names of laws and standards. So in the notes here for the background, we have the CFO Act of 1990 and then the Federal Financial Management Improvement Act of 1996. So basically what these two acts do is they encourage more disclosure, transparency, and standardization for federal governmental accounting. So I'll write that down here. Okay, so what these two acts have in common is an emphasis on disclosure, transparency, and standardization. So CFO Act of 1990, the FFMIA Act here, transparency, disclosure, standardization. The problem with federal governmental accounting in the past has been that people would have vague duties or different agencies would have overlapping responsibilities. So, for example, my first job was at a shoe store. So I worked at Easy Spirit Shoes in high school at the mall. And I was very proud of myself because it was a mall job. And I thought, oh, working at the mall is really cool. But we worked at the mall in that shoe store, and everybody was responsible for selling to the customer. And then I was kind of responsible for the register, and so was somebody else. And then somebody was kind of responsible for the back, and another person was kind of responsible for taking out the trash on certain days. But you can see how that can cause a problem, where if you have people with vague responsibilities or responsibilities that overlap, then you can have a diffusion of responsibility where less gets done, not more. You would think that if everybody's responsible for something, more would get done, but in many cases, less would get done. You'd be less effective. So with federal governmental accounting, these two standards help to clearly define lines of responsibility. Again, with this notion of disclosure, you have to report what you're doing so everybody can see. You have more transparency so the public can actually look at the financial statements and understand what they're reading, and that provides an extra layer of accountability. Right? And standardization means that you're going to reduce siloed systems. Obviously, the federal government is massive and very large with a lot of different agencies and departments. And these legacy agencies would have their own, for example, accounting system, or they would have their own account names for certain things. Whereas a different department would use a different account name for the same kind of idea or the same type of account. Right? So to get people to stop using different account names, to get people to stop being siloed, we want to integrate everything together, and that's what these two laws do. Okay, we have these different entities here. I'm going to start with the second, the third, and the fourth entity because they all have something in common. So if you look at the So if you look at the first, second, and third, the OMB, the GAO, and the Department of Treasury, all three of them were responsible for the formation of the FASAB, Federal Accounting Standards Advisory Board. So these three entities, what they all have in common is that they help to promulgate the accounting standards used by federal governmental accounting. That's called FASAB. Look at page 2. What does FASAB stand for? At the top of page 2. Federal Accounting Standards Advisory Board, right? So it's kind of like FASB, right? FASB is the entity that establishes or sets accounting rules for public companies. So FASAB establishes the rules for federal governmental accounting. So you have the OMB, the GAO, and the Department of Treasury. They all help to establish the entity called FASAB. Okay, what does the OMB do? Well, the OMB basically establishes policy. Right? So the OMB is part of the executive branch. They represent the president. So in terms of how money is spent by the federal government, there has to be policy or strategy developed, and that's under the purview of the Office of Management and Budget. So the OMB is going to establish policy. They're going to aid in program selection. Right? How should money be spent? Should we have a large infrastructure project? Should we build new highways? Should the federal budget be primarily spent this year on maintenance or redoing some of our highway system in the United States? It's going to be under the OMB. Look at the GAO, Government Accountability Office. The thing that I want to point out is that they serve as the audit arm for Congress. So the GAO, as the name suggests, the A is accountability. They basically serve as the audit arm for the federal government. Look at the Department of Treasury next. Look at the third bullet point. The Department of Treasury keeps, receives, and disburses money, prepares operating reports, maintains a general chart of accounts. Right? So how would you describe the Department of Treasury's responsibility? More like a staff accountant, right? Isn't that something that a staff accountant would do, right? Keep and disperse money, prepare reports, right? Maintain a chart of accounts. This is kind of like what you would expect a staff accountant to do. Okay, if you look at the notes, scroll down. We have the CBO, Congressional Budget Office. So the CBO is in charge of structuring the actual budget for the federal government. We learned earlier this semester that budgets are used for two purposes. Do you remember what they are? Planning and control. For federal governmental accounting, budgeting is also used as a mechanism for authority. Right? So if you have a certain budget, then you have the authority to spend money on for a certain purpose. So budgeting is also about authority in this case. Right. Good. Any questions?
Yes. What did you say FASAB was comprised of again?
FASAB?
Yeah.
What do you mean? What is it comprised of?
Like you said, it was comprised of like a couple.
Oh, okay. So if you look at the notes, so on the first page, the OMB, the GAO, and Treasury, they're all responsible for FASAB. They help to establish FASAB, and they have a big role in guiding how FASAB is structured and how it operates. Speaking of FASAB, if you look at FASAB on the second page, this is basically the entity that makes up the rules, right? So for FASAB, do you know how many board members they have? They have 10. Right? So they have 10 board members. So for FASAB, they have 10 members. From the executive branch of the government, they have 2 members. From the legislative branch, they have 2 members. And then they have another 6 that are not part of the federal government. So you have 10 members.
How are they chosen?
How are they chosen?
Only 6 people.
Typically they're chosen by through congressional approval.
Elections.
Yeah, I think if you're well connected, like if you're like very like influential, like in accounting or in certain segments of like the economy, like if you're like a corporate person or like an academic person, you can also be part of FASAB. But how come you want 6 people that are not part of the federal government? That's kind of confusing, right? Wouldn't you want like people that are like all federal accounting experts that work for the federal government to be part of FASAB? No, because you want diversity of opinion, right? So having 6 outsiders ensures that you have more diversity of opinion, and it ensures that you have a lot of different perspectives. All right, very good. Remember when we learned about state and local accounting? We learned that you have inter-period equity and accountability. Those are really important concepts for state and local accounting. For federal accounting, according to the Statement of Federal Financial Accounting Concepts number 1, there are 4 important guiding concerns or concepts for federal accounting. Let's talk about what they are. For federal accounting, number 1, budgetary integrity is important. So budgetary integrity is the notion of the creation of budgets and the comparison with actual results. So budgetary integrity means creating a budget, comparing against the actual, where you have a difference or variance. What are some concerns that come up with budgetary integrity? If budgetary integrity means I'm going to create a budget, compare what actually happened, and figure out the variance, what are some things I have to think about if this is my responsibility or if this is an important concept? You have to think about how the budget is created. Budgets should be based on normal standards, not like perfect or ideal standards. So if you create a budget that is like ridiculous, that doesn't make any sense, right, then obviously the results don't mean anything. The actual results have to have some veracity to them. You have to make sure that the actual results are correct, right? They're verifiable in nature, that they have some decision usefulness. So when you create budget to the actual and look at the difference, a lot of different things come into play with budgetary integrity. Operating performance means exactly what it sounds like. It means the effectiveness of the government's initiatives. So how effective were your programs that you implemented this year? Operating performance, if it's about the effectiveness of your programs or initiatives, operating performance also implies that you have to find a metric to measure how effective they were. Right? So with operating performance, we can say, okay, well, we want to make sure that our programs are effective, but how do you measure whether they're effective or not? We talked about different ways of measuring effectiveness for not-for-profit entities. Do you remember what they were? You can look at, Morgan, what did you say? Right, so the input-related ratios or metrics, output or outcome, or some combination of the two. What does stewardship mean? Anybody know what stewardship means? If you're a good steward of something? Anybody know stewardship? It's not a very commonly used word, per se. Stewardship is about custody and use, proper custody and use. So stewardship is this notion of proper custody and use of resources. What are the safeguards that are in place to make sure that you're reducing the chance of error from intentional or unintentional sources? So stewardship is this notion of proper custody and use of resources. Stewardship is so important that this last concept here is really a subset of stewardship itself. Adequacy of systems and controls. This is the notion of ensuring that you have proper internal controls in place to prevent misstatements from occurring. What does a misstatement mean? It could be an error. A misstatement means that the financial figures are incorrect. And financial figures can be incorrect for one of two reasons. An error is unintentional. Fraud is intentional. Right? So you're trying to prevent misstatements from intentional and unintentional sources. So that's what we mean about adequacy of systems and controls. Okay, all right, outstanding. Any questions so far? Okay, all right, so we have a lot of different funds that are used. So let's look at number 4. Okay, so I think you all remember the funds that are used by state and local governmental accounting. Do you remember what they are? This is a good review for the exam next week. General, special revenue, capital projects, and all that stuff. Okay, so the federal government also uses funds as well. So you can see that they have 6 different funds listed. The first 4 are the most commonly used funds. And the last 2 are not always used by every department within the federal government. The general fund is one fund for the entire government. The general fund is just like the general fund for state and local governments. The general fund is used to account for core governmental activities. What are some core governmental activities? Maybe collection of income tax would be one example. Another core governmental activity would be, like, for example, paying federal employees. Right? Those are core governmental activities. So the general fund, you have one for the whole federal government. And if you look at these other funds, these are more specialized in nature. So everything down here is specialized. Special fund is just like what? What do you think? Special revenue fund. Right? That's the best definition of a special fund for the federal government. For the federal government, special fund, it's just like or similar to a special revenue fund for state and local governments. What does that mean, special revenue fund? This is like a special revenue fund. What do you think? Yes?
When you can spend both the earnings and the principal.
Okay, so that's right. Okay, very technical definition. You can spend the earnings and the principal
For a specific
purpose, and you typically have a dedicated revenue stream for that purpose. Right? It has to be for to benefit the general citizenry. That's right. What a very comprehensive definition. Okay, so the rest of these funds have a definition that's a little bit different than what you might think. A revolving fund is like a proprietary enterprise fund. So revolving fund, proprietary enterprise. Proprietary enterprise. So that means when the federal government transacts with somebody outside the federal government in a reciprocal transaction for like a service or good, that would be under the revolving fund. Can you think of an example of a revolving fund transaction? Basically, proprietary enterprise. What do you think? From the federal government? I believe it or not, that can actually happen. Like the federal government may seize like some drug lords, like, assets, and possibly like auction it off to the public. That would be under the revolving fund. Good. I was thinking more like, I got a global entry card. They interview you and they fingerprint you, and then you don't have to go through a long line when you go internationally. I had to pay for that. That could be under a revolving fund also. Management fund is sometimes used. It's basically a proprietary internal fund. So proprietary internal fund. Remember the internal service fund? This is just like the internal service fund. What would this be like then? Enterprise fund. Remember enterprise? So this is, if you compare this to state and local governmental accounting, this is like state and local governments have a general fund. Instead of special fund, what's it called for state and local governments? Special revenue. This would be most similar to enterprise, and this would be internal, right? A trust fund is used to account for earmarked activities. So if the government has an earmark or specific special purpose that something has to be used for, it would go into a trust fund. Like Social Security, isn't Social Security a trust fund? What is Social Security earmarked for? For paying out benefits to retired people. Okay, deposit fund,
Can I ask a question?
sure.
Would that be like the fiduciary,
Yes, it is like a fiduciary. It's like a fiduciary
right, the person?
private purpose fund, right? Fiduciary private purpose trust fund. Okay, if that's the case, deposit fund is just like an agency fund. The deposit fund is an agency fund. What is an agency fund? Do you remember? Agency fund means, what's an agency fund? Agency fund means it's like a holding account, right? So you have money that belongs to somebody else. So it goes into a deposit fund. Okay, all right, good. Any questions on these? Okay, we're going to talk about federal accounting and how they use dual track accounting, just like state and local governments do. But let's come back to this in just a moment. I want to talk about the financial statements that federal governmental accounting has to generate. Let's take a look at page 3. Okay. All right, so on page 3, you see number 6, basic financial statements. So we have basic financial statements. We have actually 6 of them, as you can see. And then these basic financial statements all become part of the consolidated financial report for the entire U.S. government. So you see the 6 statements there. They all flow into the statements that you see at the very bottom. Okay, so let's talk about these basic financial statements. And I have a copy of the financial statements for the entire U.S. government, which we'll look at. I posted it online too, in case you're curious and want to look at it, like over like the holiday or something, like summer break and all that stuff. Okay, balance sheet. Okay, so balance sheet for the federal government consists of assets, liabilities, and net position. So for the federal government, you have assets, liabilities, and net position. Now for net position, this is kind of like stockholders' equity, net asset, right? Retained earnings. For the federal government, you have 2 kinds of net position. Unexpended appropriation. So unexpended appropriation is money that is essentially reserved or restricted in nature. Then you also have cumulative result of operations. Cumulative result of operations is like unrestricted. So for net position, this is restricted, unrestricted. All right. Okay, next you have what? What statement? What's the next basic financial statement? Net cost, right? This is very interesting to look at. We'll see in just a moment. Statement of net cost is a listing of cost by strategic goal. So strategic goal. Now strategic goal is actually, as you'll see, broken out into like departments. So you have, for the statement of net cost, you have like Department of Health and Human Services, the Department of Defense. Right? Those are strategic goals, and that's how they break them out. So for statement of cost, you have the cost by strategic goal, and also each department or each strategic goal might generate a certain amount of revenue. So you'll also see what the revenue that's listed. So you'll see cost and revenue. Okay, I know this is not going to make a whole lot of sense until we actually look at financials. So just like as an overview, just kind of understand what this is talking about. Next we have statement of changes in net position. So statement of changes in net position reconciles net cost and net position, like beginning and ending net position. This is basically like statement of retained earnings. What's on a statement of retained earnings? Beginning retained earnings plus net income minus dividends equals ending retained earnings. Statement of net position is going to have beginning net position. It'll show your net cost. It'll show revenues and your ending net position. So it reconciles beginning net position and your ending net position. What's the fourth basic financial statement? Statement of budgetary resource. This talks about two things. It talks about your budget in terms of how you obtained something and what is the status of what you've obtained. Okay, so I'll write that down. So we have how something was obtained and its status. So for example, we have $1 billion that we have budgeted for a certain program. What is the status of that money that was budgeted? Has it been expended? Is there an obligation? Is there an apportionment or an allotment? And we'll talk about what those mean later on. So here in the statement of budgetary resources, you have all the budgeted items, all the things that you plan to spend money on. So of course you're going to have the amount, right? And also, what is the status of the money that was budgeted for a certain purpose? What is the next statement? Statement of custodial activity, right? So it says if applicable. So statement of custodial activity is money that belongs to somebody else. Right? Statement of custodial activity. This is where you account for other people's money. So for example, if you have let's say payroll taxes that you aggregate and you have to turn it over to the IRS, that would be in the statement of custodial activity. What's the last basic financial statement? Statement of social insurance, right? For example, Social Security programs, Medicare, Medicaid. This is going to be for things like Medicare, Medicaid. What is the difference between Medicare and Medicaid? Does anybody know? I don't think anybody uses it. You're too young. Medicare is health insurance for old people. Medicaid is health insurance for poor people. Right, exactly. Any questions on the basic financial statements? Okay, so you can see that the basic financial statements really just consist of these four, right? Because these last two are optional and don't apply to every entity in the federal government. So these four statements that you have kind of are similar to for-profit entities. What would be the for-profit equivalent of a balance sheet? It would be called a balance sheet. What about statement of net costs? What is that kind of similar to? And if it has cost and revenue in it, it's similar to an income statement, right? What about statement of net position? It's kind of like statement of retained earnings. Statement of budgetary resource is not so similar to for-profit accounting because for the government, for state and local governments, for the federal government, budgeting is more important and more emphasized. But you could roughly say this is kind of like a cash flow statement, right? Because you have to, if you have to account for cash, you can't hide something under the accrual basis of accounting. Okay, so these are the basic financial statements that you have up top. And then at the bottom, these are the formal names for the statements that you would have in the consolidated financial report for the whole U.S. government. All right. Okay, so how do they match up? Look at this, everybody. So balance sheet, that would be the same as the balance sheet down here. Right? Statement of net cost would be the statement of net cost at the bottom. So you can see the statements at the top. These statements are either combined together or they appear as a separate statement at the bottom here. Okay, all right. Any questions so far? So I saw some people were trying to peek over at this again. All right, any questions on the basic financial statements? All of these things are going to be the ingredients that we're going to combine together in the consolidated financial report for the whole U.S. government. Has anybody ever seen the financial report for the entire U.S. government? All right. Let's take a look at it. Okay, so here's the most recent consolidated financial report for the United States government. The first thing you'll notice is that the fiscal year for the U.S. government ends on the last day of September. Okay? So it's not December 31st. It's not a December 31st year end. It's September 30th. Why is it September 30th? Why not just make the fiscal year end for the U.S. government December 31st? Anybody know? Yes?
Because when the budget is made?
Okay, so there's a timing lag between the actual preparation and implementation of the budget. But another reason is because when are taxes due? April 15th. All right, so they make it a couple months after taxes are due because the biggest revenue source for the federal government is income tax. Okay, so they talk about all the things that we mentioned, like what is a statement of net cost? Okay, which we talked about. What is a statement of operations and changes in net position? We'll see. All right, let's take a look at the financial statements. I'm very curious to see. Okay, look at this. Statement of net cost. Okay, this is kind of like an income statement. You can see we have cost here. Then you have earned revenue here, right? You have the subtotal. Okay, you have gains and losses, changes in assumptions. This is basically like if we have to adjust something or if we made a mistake, put that in here. And then you have the net cost. Okay? Statement of net cost is by strategic goal, or I said before, by department, right? Okay, so these are in billions of dollars. So everything here is in billions of dollars. If you look at the bottom, you can see that the entire budget for the US government is $4.5 trillion, right? Because this is $4,541 billion, which is 4.5 trillion for 1 year. Okay, so if you look at this statement of net cost, what is the biggest expense for the US government? Department of Health and Human Services. That's 1.1 trillion. Do you know what that is, really? That's Medicare, Medicaid, actually, health benefits for people. What's the second biggest expense for the US government? Social Security Administration. That's a huge number. You know what this is? Social Security payout. So Social Security benefits for people. I don't know if you saw in the news that they were saying that Social Security is going to start to run out of money by 2035. Right? So you can see that Social Security, Medicare, Medicaid, these are the two largest expenses for the federal government. Together, these account for approximately 46% of the entire federal budget each year. So almost half goes to Social Security and then Medicare, Medicaid. What is the third largest expense for the federal government? Defense, right? About $700 billion. Actually, if you include Department of Defense and Department of Veteran Affairs, right? If you add these two up, you can argue that the defense spending for the U.S. government is about 25% of the total. Right? If you add up these two numbers. All this stuff is on Blackboard, so you can look at it later on. It's the defense and then Veteran Affairs. Okay, so if the two largest expenses are Social Security, Medicare, Medicaid, defense, what's the third largest expense? Interest on the debt. Right? So the federal government obviously borrows a lot of money, so the third largest expense is paying interest on the money that's borrowed. Okay, if you look at these different categories, there's like a lot of interesting categories here. Yes.
What are the assumptions you're talking about? The gain or loss from changes in assumptions? Because this is the actual, right?
Yeah. So like, one of the big ones is you would have an initial estimate for something, and then since this is prepared later on, you would know the actual amount. So that would be the adjustment that you would make for the assumption. You can see that the biggest change in assumption is like Veteran Affairs, because they would accrue like what they think is going to be like their medical expense cost, but the actual may be different, right? So that's why the biggest adjustment is here for Veteran Affairs, because Veteran Affairs typically pays out veteran benefits and then also like people go to like a VA hospital. And also Veteran Affairs, if they pay out like something to a member of the military, there could be like a change in an estimate too. Like if we have an actuarial change in how long we think people are going to live, that's going to cause a change in assumption as well. Okay, any interesting categories that you see here? I see some interesting categories. Like I think I know what Department of Labor, Department of Education, I think I might know what they mean. But what is Security Assistance Account? What does that mean? You know? Anybody know? Foreign aid to other countries. That's what that is. Actually, foreign aid is in 3 places. Foreign aid is here. Security Assistance Account, that's about 38 billion. It's also here. Let me scroll down. Right here. You see U.S. Agency for International Development. Right? That's USAID. That's actually started in the early 1960s by President Kennedy. And that's a program that administers aid to other countries. Okay? And it's in one more place, actually. Millennium Challenge Corporation. That is actually foreign aid also. That was started under the Bush Jr. administration. What percentage of the budget goes to foreign aid? Looks like it's in 3 places, but do you know what percent it is? What do you think? What percent of the budget goes to foreign aid? It's very low, actually. Even though it's in 3 places, it's like in the single digits, low single digits. Like anywhere as low as like 1%, like 2%. Right? What percent of the budget goes to paying interest? Do you know? Right now, it's projected to go higher, but what percent? Do you know? It's about 5 to 6%. Okay. All right. What is the Tennessee Valley Authority? Do you know what that is? TVA? Yes. Yes, exactly. That was started under President Roosevelt. And that program, that program is in place to try and provide electricity, utilities to remote locations in the United States. And then you can see that program is pretty old, so now it's actually generating more money than it's costing. What is the Pension Benefit Guaranty Corporation, the PBGC? What that is? If companies go bankrupt and they can't pay their pension, the pension is actually guaranteed by the federal government by this entity, the PBGC. But the benefit is like very low. It's like only like 25,000.
But why the number is negative? The negative.
Oh, because they don't have to pay out any benefits. There's not that many U.S. companies that are going bankrupt, so they actually are not paying out. The net is that they're taking in. And then Smithsonian Institution, you can see there. All right, so is this encouraging or depressing? What do you think? Okay, I'll show you something I think is kind of depressing. Okay, this is for 2017. Okay, so we just saw 18, this is 17. I want to show you, if we go down, I'll show you the balance sheet for the federal government. So they have more detail on what you see in the statement of net cost. Okay, balance sheet for the U.S. government. What are the U.S. government's total assets? $3.8 trillion. What about their liabilities? Liabilities are 25. Ooh, that's a big number, right? $25.3 trillion. What is the biggest liability? Debt. Right? The federal government borrows money by issuing bonds. Right? So what is the total, like the equity of the federal government? It's negative, right? So is that good or bad? What do you think? You think it's bad? So the U.S. government has a lot of debt, more liability than assets. Is that good or bad? What do you think? Nobody really knows, actually. The theory behind this is called functional finance. Have you heard of that term before? Functional finance is the notion that the purpose of the government is to do a couple things. The purpose of the government should be to ensure full employment, ensure growth of the economy, and ensure low inflation. That's what the government should do, those 3 things. And if the government has to have a lot of debt to do that, overall it's okay. How come it's okay? Like for most people, it's not okay to have huge debt because eventually it'll catch up with you, right? But people only have a limited lifespan, but the federal government has unlimited life. That's one thing. The other thing the federal government can do is print more money, and nobody else can do that, right? The problem with printing more money is that you might encourage more inflation. So that just means that you can't have too much debt, but some debt is okay. But this is a huge political question too. Some people think this is okay, and other people think, no, we have to balance the budget and the liabilities should get smaller. But one thing that everybody agrees is that if the interest payment gets too big, then the largest expense is going to be interest and not defense or anything else like that. Okay, all right, so that's kind of interesting. Any questions on this? All right, let's talk about dual track accounting. Okay, so remember for state and local governments, you had dual track accounting? What was dual track accounting for state and local governments? Do everything twice. At the fund level and then at the government-wide level. For federal accounting, we have dual track accounting. We do everything twice again. But this time we do it at the budgetary level. This is the authority level. So authority is one of the most important things for the federal government because there's just a lot of money. And if you're given money, you have to have the authority to spend the money, right? So we do dual track accounting at the budgetary level and then also at the proprietary or full accrual basis level. Okay, so what are the different types of budgetary accounts we're going to use? This is going to be on the test next. We have appropriation, apportionment, allotment, obligation, and expenditure. Let's list them on the board, and we'll talk about what they mean, and then we're going to do a problem together. Oh, before I forget, I have a question. Do you all think you'll collect Social Security? I'm just curious.
No.
So you think you're going to get nothing when it's your
Until they
turn?
redo the system.
I'm just curious. Like, I'm closer to you all, because I'm older than that. I mean, I don't know either what's going to happen, because nobody really knows, but I think probably you don't have to worry. Because if they don't pay Social Security, it's going to be a huge problem for our people. So probably they'll pay you. Okay, so we have apportionment. Appropriation. Let's start with that. Apportionment. Allotment. Obligation. And then expenditure. Okay, all right. So appropriation is where you are allowed to spend money by the highest level of the government. Okay, so think like the president signs like a budget. Right? So appropriation is the authorization to spend money from the highest source. So Congress passes a budget. They sign off on it. Majority of people agree to it, and then money is appropriated to you. Okay, once you have money that's appropriated to you, the next step is you have to apportion it. Apportionment means that you are reserving the money by time interval. So apportionment means that you're going to figure out some time interval. So you budget funds by time interval. So that means, for example, I am appropriated $100. Okay, so in quarter one, I'm going to spend 30. Quarter two, I'm going to spend 20. Quarter three, 10. You know, that kind of thing. That's what apportionment means. It's kind of like if you have a vacation budget. I have a $1,000 vacation budget. That's appropriation. On day one, I'm going to spend $100. Day two, $300. That would be more apportionment. Allotment is where you subdivide the money. So allotment is where funds are subdivided. That means that the Department of Homeland Security gets money. They figure out how the money is going to be spent. Right? I'm not going to spend the whole thing in the first month. And then I'm going to divvy out the money to the lower levels or divisions within the entity. So after these three things are done, when I actually go out and order something, that's called what? It's called an obligation. Right? So you have some type of purchase order. when you actually receive the item and you spend the money, so you receive and spend money, that's called an expenditure, right? Right. Any questions on that? All right. If you look at page 4 from the notes, take a look at page 4. It does, doesn't it? It does seem more complicated, right? Because it's a big entity and they have all these different steps. Okay, so look at page 4. Okay, so you have an appropriation. It says Congress passes H.R. XYZ and the president signs the bill, creating an appropriation to fund an agency's activity. Right. So you have an appropriation, and then next comes the apportionment. For the apportionment, you establish how much is going to be spent each quarter. Right. So I get the money, then I have to have a plan on how I'm going to spend it. After I get money and have a plan for how I'm going to spend it, what do I do next? I'm going to allot the money, like actually distribute the money out. So really, before any monies are spent, there are 3 steps that have to take place. You have to get the money, figure out how you're going to spend it, and then give the money to people to spend. When money is actually spent, it's going to create what? An obligation, right? And when you actually receive the item and pay for it, it's called an expended appropriation or expenditure. All right. Good. Any questions on that? All right, there's only one more thing we need to talk about in this chapter. So we're going to talk about how to do the journal entries. It's not that bad. I know it looks terrible. I think almost everybody's seeing this for the first time, right? Does anybody read the book? Okay. So you're probably seeing it for the first time. This is kind of sad. Just being honest. Okay, so you can put this on your sheet for next week. You have appropriation, apportionment, allotment, obligation. And then I said that we do everything on 2 levels, right? There's 2 sets of journal entries. You have the budgetary accounting journal entries, and then you have the proprietary, basically the government-wide journal entries. My favorite journal entries are actually the proprietary journal entries because you don't have to do anything except in the first step and the last step. Right? So you can see proprietary when you are appropriated money, right? When you're appropriated money, this is basically like cash. It's like debiting cash, and this is like crediting transfer in. Okay, that's what you do at the proprietary level. If you're allowed to spend money, if somebody's going to give you money to spend, you actually don't have cash. You have a fund balance. You have like a line of credit, so this is like cash. And then you have unexpended appropriation. That's like a transfer in. Okay, so that's what you do at the proprietary level. When you spend money, look what you do. You just make a normal journal entry like you would ordinarily see. Like you buy equipment, you have expense, you have an account payable, right? When you actually pay something off, you don't use cash. What do you use? You use fund balance with treasury. So for the federal government, instead of having cash, you have what's called fund balance with treasury. I think if you were to replace this with the word cash, that would make all these journal entries would make more sense on the right side. All right, good. All right, any questions on that? Okay, for the budgetary accounting, it's actually not as bad as you think, because what happens is when you receive an appropriation, what do you debit? Appropriation, right? And then you have what's called an unapportioned authority. Right? So when you receive money on the budgetary level, you have an appropriation and you credit unapportioned authority. when you have an apportionment, what goes down? Unapportioned authority. And what's going up? Apportionment. When you do the next step, when you have an allotment, what goes down? The apportionment goes down. What goes up? Allotment goes up. When you have an obligation, what goes down? Allotment goes down and the obligation goes up. And then when you expend the money, then the obligation goes down and then you've spent the money.
So what is unapportioned authority?
Unapportioned authority is basically like showing an increase in something. It's for the budgetary accounting, it's not really like something is like coming in or out. It's more about like what part is going up and what part is going down. So when we have an appropriation, a couple things. One is you have appropriation realized. You notice that this account never like goes away. Like you debit the account, but you don't credit the account anymore, right? The last account that you credit is expended appropriation. So when all these journal entries are done, most of them are going to cancel out. Like, for example, you see apportionment here and apportionment here. This is a credit and that's a debit. Allotment is a credit here and a debit there. Most of the accounts like zero out by the end, except for appropriation realized, because that's going to track like how much you're allowed to spend. And this account is going to be the only account that's left over. This accounts for how much you actually spent. So in intermediate accounting, do you remember like CIP and billings on CIP, they're supposed to balance? Right? That's the same idea here. This is like CIP, and then that's billings on CIP. So to answer your question, what is unapportioned authority? It's basically the appropriation that you're allowed to spend. And then the appropriation goes down. It's confusing because they just don't use that word. Right? When your apportionment goes up here, later on it's going to go down and become an allotment. When you use up your allotment, it goes down and the obligation goes up. When you have an expenditure, the obligation goes down and then it goes into this final account called expended appropriation. All right. Okay. Great. Any questions on that so far? All right, you want to take a break? We'll come back. And then we'll go over how to do the journal entries. Problem 1, federal government accounting. Okay, so the good news is you need to know 1 through 5. Okay, I'll post the answer to the whole thing if you're curious, but for purposes of this class and for the exam, I'll only ask you 1 through 5. And then you can take like a federal accounting class later on and go into more detail. Okay, so problem number 1. Okay, so for problem number 1, we have different transactions, and we're going to record the transactions in the budgetary accounts and the proprietary accounts. Right. Remember, budgetary accounts, you have different accounts that are used. You have appropriation, apportionment, allotment, obligation, expenditure. So 5 different steps. Right? When it comes to proprietary accounting, you don't have 5 steps, you just have 2, right? Once you are appropriated money, that's like somebody's giving it to you, that's 1 step. The second step is you actually spend the money, that's the second step. Right? So in this problem, problem number 1, you have 5 things that we're going to do. So I bet you it's going to go over all 5 steps. Okay, so let's put budgetary here. And we'll put proprietary over here. And then let's do the journal entry for each of the 5 different steps. Okay. All right, and then what we can do is we can look at the handout to help us. So we can look at the handout that we have in class, this landscape handout, and then this will help us to figure out what the journal entries are going to be. Okay, Lauren, read number 1, please. The Flood Control Commission.
The Flood Control Commission received official notice that 1 year appropriation passed by Congress and signed by the president amounting to 7 million for operating expenses.
Okay, so you are allowed to spend money by the highest level of the government, like even the president signs off on it. That sounds like an appropriation, right? So number one, we're gonna make the journal entry for an appropriation. Okay, so for budgetary purposes, you have appropriation realized, right? So again, it's just gonna be the handout here. You can use it as a template to help you. So you have an appropriation that's realized, so we have to record that. Appropriation realized. That's 7 million. And what do we credit? Yes. Unapportioned authority. That's right. Unapportioned authority. That's 7 million. Okay, so two things. One is appropriation realized is tracking like the amount of money that they gave us to spend. And then unapportioned authority, that's going up right now. When we do the next step, unapportioned authority is going to go down, and then apportionment is going to go up. All right, let's just do all the budgetary, and then we'll come back to the proprietary. Okay, so what does number 2 say? Thomas, it says the Office of
Management and Budget notified the Commission of the following scheduled proportions. First quarter, 2 million. Second quarter, 2 million. Third quarter, 1.5 million. Fourth quarter, 1.5.
Okay, good. So in step 2, it looks like once we've received an appropriation, we are trying to figure out how we're going to spend the money, right? So that's called an apportionment, right? When you figure out how you're going to spend money, that's called an apportionment. Number 2 is apportionment. Okay, so let's just combine all the numbers together and just make the overall journal entry. How do you make a journal entry for apportionment? Well, what about this unapportioned authority? If I'm apportioning money, this unapportioned authority is supposed to go down, and apportionment is supposed to go up. So how do I make unapportioned authority go down? You're going to debit. All right. And then if you add up all those numbers, how much does that add up to? 7 million, the whole thing, right? 7 million. And then this journal entry is going to debit unapportioned authority because it's going down. And what's going to go up? What do I credit? Apportionment. Right, it's going up. All right, so you can start to see like a pattern now. Right? In the next step, what do you think is going to go down? Apportionment, and what's going to go up? Allotment. Let's see. For number 3. What does number 3 say? Oh, this is like straight out of central casting. It says, the Flood Control Commission allotted $1 million for the first month of operations. Remind me, what does allotment mean? It means distributing the money, right? You're distributing the money. So allotment. Okay, so the allotment looks like it's for 1 million. Help me out here. What's going to go down? The apportionment's going to go down, so I guess you're supposed to debit apportionment. This is for 1 million. And then we have to credit something to make the journal entry balance. The credit is going to be the thing that's going up, which in this case for number 3 is the allotment. Right? 1 million. Okay, good. Okay, I have a question. What do you think is going to happen in the next step? I bet you the next step, the allotment is going to go down and the obligation is going to go up, right? I'm not sure, but that's what I think. Let's see. For number 4. Number 4, I'll read it. It says, obligations were recorded for salaries and fringe benefits. You have 400,000, furniture and equipment 270, materials, supplies 250, Rent, utilities, 50,000. The commission does not record commitments prior to recording obligations. Okay, so long story short, we can make like a journal entry to combine everything together. We're doing like a global journal entry at the highest level, right? So for number 4, it looks like the key word in number 4 is obligation, right? So you have a lot of obligations that are happening here. So number 4, we have obligation. Yes, obligations. So when recording an obligation, what's the first thing that has to change? Something has to go down, something has to go up. Allotment's going to go down, right? So we're going to debit allotment. So this does seem like a lot of extra steps, right? A lot of extra steps for something that you would assume shouldn't be that complicated. If you add up all the numbers, what does that all add up to? 970,000, that's right, 970. For journal entry purposes, I am going to record an obligation though. So how do I record an obligation? Credit, obligation. I think a lot of people look at these budgetary accounting entries and they think, oh, well, is that an asset or is that a credit to like a liability? It's not an issue of asset, liability, revenue, expense. It's more about tracking everything, authority. Like if I have like the authority to spend money, that's why I make a journal entry. This is how much money I'm allowed to spend. So we're going to put that in an appropriation. When you're apportioning the money, the appropriation goes down, the apportionment goes up. When you're allotting the money, the appropriation goes down, the allotment goes up. When you have an obligation, the allotment goes down, the obligation goes up. So it's really constantly what's going up and down. Where is everything moving from one step to the next step? What's the 5th step? The 5th step is expenditure, right? Or expense. I'm going to squeeze that here, number 5. What does 5 say? Payroll is $170,000, right? If you have payroll, which you paid, then I think we shouldn't have any more obligation, right? We should have an, I'll squeeze it down here, expenditure, right? How do you record obligation going down and like you're expending money or using up your appropriation? Debit obligation, right? So obligation, debit. And then how much was that for? 170. Okay. And then this is budgetary, right? It's not like cash. What do you credit? Expended appropriation. Right?
If you were to ask us a question like this on the test, would you want us to break down the obligations into their like actual names?
You
or
can
just, like,
actually. You can do obligation dash, like specific things, but I'm not going to ask you to do that. On the exam, I'll give you like a problem that's just like this, honestly. I'm not going to make your life difficult. Okay, so I have a question, a couple questions. Let's say we do all these journal entries for the whole year. What's going to eventually happen to this account? Is it going to go up, down, or disappear? Well, it already did disappear, right? Does that make sense? What about apportionment? Assuming like we spend everything and it goes through all 5 steps. What happens to apportionment eventually? It's going to disappear, right? Allotment is going to disappear. Obligation is going to disappear. The only 2 things that are going to be left are this, which records how much you were allowed to spend, and this, which records how much you actually spent. So you can compare the 2, and that's part of the budgetary process, right? This is how much was budgeted, right? And this is how much was actually spent. Right? So you have budget to actual. Yeah, budget to actual. Okay, so Thomas.
Can you say expenditures instead of expended appropriations? Or do we have to say?
It's supposed to be expended appropriation. That's the formal account name. Okay, so you're supposed to do that. You could say expended appropriation dash expenditure for expenditure. That would be fine. Another name for this is called expended authority, like unapportioned authority and expended authority. But, you don't have to worry about that. Okay, all right, so that's the budgetary journal entries. What do you think? A little bit better? How about proprietary? I like proprietary because you only do something at the beginning and only at the end, right? So I'm only going to do something at the beginning and at the end. Oh, so that's good because here I just put no journal entry. For number 2, number 3, no journal entry. Number 4, no journal entry. When I was a TA in grad school, the professor I TA'd for, she said, oh, people have to write no journal entry. If people leave it blank, it means they don't know the answer and take off full credit. I'm like, okay. So if you just leave it blank, that's fine, I don't care. All right, so proprietary, this is like full accrual accounting. Here, number 1, you're getting the money. Number 5, you're spending the money. So that's the only time you have to make a journal entry. It's like cash basis. When you get the money, when you spend the money. So in number 1, how much money did we get? How much money were we appropriated? 7 million, right? So I feel like, don't write this down, I feel like I should debit cash and credit like some kind of transfer in, right? But we don't use those accounts. Instead of debiting cash, what do we debit? Fund balance. Fund balance with treasury. It's kind of like cash or an account receivable. That's for 7 million. Instead of crediting revenue or transfer in, what do I credit? Unexpended appropriation. 7 million. All right, good. Okay. What about at the end, like number 5? What happened number 5? We had, looks like we had like some payroll expense, right? So if this is full accrual accounting, if you have payroll expense, you should debit payroll expense. Right? Payroll expense. How much was that for? 170,000. 170,000. If you paid it in cash, I feel like I wouldn't credit cash, but I can't. I'm supposed to use fund balance with treasury. Okay, good. So this is full accrual basis of accounting. This is like cash. That's like revenue or transfer in. Here you have an expense, and then your cash went down, right? So after we make these 2 journal entries, do you have any cash left over? After we make journal entry 1 and 5, is there any fund balance of treasury left over? Yeah. What about this unexpended appropriation? That's like revenue or transfer in. That's going to be on our books also. All right. Okay, so one more time, everybody. Budgetary accounting for federal government, 5 steps, everybody. Appropriation, apportionment, allotment, obligation, expenditure, right? And then put that on your formula sheet, right? And then you'll see a question just like this on the exam.